Good afternoon, guys. Uh, my name is Qasim Ishtaq, and I'll be teaching you guys the financial reporting data F7 for the ACCA. I hope all of you guys are doing well. Okay, let's start with a brief introduction. Kindly give me a little background information about yourself. Let's start from Ms. Kashika. Kindly introduce yourself, ma'am. Can you guys hear me?
Yes, we can hear you.
Okay. Why don't you start with your introduction? A little bit of background about yourself. A little
Okay.
what papers have you already?
My name is Vidushi, and I work in the telecommunications sector in Mauritius. I have done company
Mm-hmm.
law, performance management, but I'm waiting for results for performance management. And now I'm going forward to doing F7.
Okay, that's good. And who's the other one over here who's active right now? Any other student? I just need to make sure that all of you have studied and cleared your F3, right? F3 is
Yes, I
cleared. This is
have.
the basic assumption that
Yeah,
I'm taking.
yeah.
Okay. Okay, now let's start with the F7. If we talk about the F7 and if we go for, let me just set it a bit. Okay. As far as F7 financial reporting is concerned, overall, if we talk about this paper, this is a comprehensive one, and this is a very advanced exam paper when being compared with the F3, that was the financial accounting. If we go for the exam format, and if we talk about the exam format over here, this actually now has three sections. Section A, it will have 15 MCQs, and that will be of 2 marks each. Total will be 30 marks. For section B, you will again have a total of 15 MCQs. But over here, these MCQs will be divided into 3 scenario-based questions, or a scenario will be given to you guys, and you will be solving 5 MCQs from each scenario. 5 MCQs for each scenario. And again, overall, this will be weighted as 30 marks. And then section C, this will have 2 comprehensive questions of 20 marks each. That will be a total of 40 marks. This is your overall 100 marks paper. And obviously we all know that the passing percentage is overall 50% if we talk about the paper. Now if we discuss the section A of the paper, which will be comprising of the 15 MCUs, the coverage of the syllabus, or the syllabus area which will be tested over here, is very wide. It can ask you the question from the very first chapter, or it can ask you the question from the very last chapter as well. So this is something we will have to focus very firmly as far as the concepts are concerned. Similarly, for the section B, over here again, the examiner has a choice of the variety of the topics from where he can easily test you related to a one single specific sum accounting standard, or related to multiple accounting standards, because He will be giving you a scenario, and then afterwards there will be the 5 MCQs from each scenario that you will have to answer. As far as the section C is concerned, these are the comprehensive questions where you can be tested against a single entity, like financial statements. You can be asked for the group accounts. Obviously, we'll be doing the consolidation and the group accounts. Then again, the examiner can ask you about the cash flow questions or the interpretation of the financial statements, that is the ratio analysis. Overall, our approach will be that we will be covering each and every accounting standard in a very comprehensive way. And afterwards, obviously, we will be doing the practice along, we will be doing the exam kit as well. We will be doing some other questions, I'll be providing with the notes and every stuff which is being required to you guys. Okay, so let's start. And today, first of all, we will start with the utmost important standard, and that is basically IAS 16, and that is property, plant, and equipment. Property, plant, and equipment is basically a standard which deals with the tangible, non-current assets. Any of you, do you guys have an idea about the tangible, the word tangible? Any idea about the word tangible? Any one of you?
It's a fixed asset, one which you can touch.
It's a fixed asset, which one you can touch. I just only asked about the tangible ones, not the non-current asset. Obviously, it's a fixed asset. But uh, can it only be touched? Any other, a more comprehensive or more, in-depth analysis of the word tangible? I mean, obviously, the word tangible goes for, which you can touch, but there are a lot of things which you can't touch, but they are tangible as well. Like any other word or having in mind or something. Okay, let me tell you. The word tangible means to have a physical substance or existence. See, this is the main crucial, or this is the main, the crucial point over here. For the tangible, it needs to have a physical substance or existence, because there are a lot of things which are tangible, but we can't touch, obviously. So the tangible non-current assets, the assets or the category of the assets which are we going to discuss over here in IAS 16 are the ones which have a physical substance or existence. Now, IAS 16 define property, plant, and equipment as asset held for production. The asset which is held for production is being categorized as the property, plant, and equipment for rental to others, for administrative purposes, held for administrative purposes, for rental to others. See, over here, if we talk about for the asset held for production, we can say plant, machinery, all of the plants, all of the machinery which is available for the production is being categorized as the property, plant, and equipment. Asset held for held as a for rental to others. For example, if you are into a business of a rent a car, rent a bike, or if you have a house or a factory or a land which you rent out to other people for for their uses or something, then it is being classified as a tangible non-current asset. You have an asset for the administrative purposes, for example, the infrastructure of a building. Obviously, if you talk about a university or if you talk about an office, and the infrastructure which you have over there is being categorized as the administrative purposes. So we can say the infrastructure that you have over there is being categorized as the administrative purposes. Similarly, the asset which is used for supply of goods, it will be categorized as a tangible non-current asset as well. For example, your delivery vans, forklifters, trucks, and all, like, the lorries, we can categorize those as the tangible non-current assets. This is a basic guideline, or this is a basic, like, light, or like, a guideline which has been available by the standard, which guides us that what is a property, plant, and equipment is. Then we go for the initial measurement. If we talk about the initial measurement, we can say IAS 16 allows all non-current assets to be initially measured at cost. That IAS 16 allows all non-current assets to be initially measured at cost. That initially, first time, whenever we have to record an asset into the financial statements or into the books, we will be recording on its cost. If we talk about cost, then the standard gives us a guided, like, the definition, which states that all the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use. Now let me correct the spellings. Okay, the definition of the the definition of the cost for the non-current assets is basically all the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use. That means from buying the asset to ultimate its usage, from buying the asset to its ultimate usage, the expenses which you incur will be categorically added to its cost. Then, then afterwards, if we move ahead and look into an example, a basic example or a general example, just for the sake of the understanding, I'm telling you guys. For example, as we can see over here in Pakistan, this is like, the weather is quite very hot. So we can take up an example over here. According to the weather, we say we go to a market and we buy AC for ourselves. Okay, we are going to the market and we are buying an AC, we are buying an air conditioner. Okay, we are buying the AC, and for that, for example, like, I would say that I'm paying around like $1,000 for the AC, okay? And as far as the delivery is concerned, when I buy AC from the shop or from the market, obviously I didn't buy it like, to put it over there. I just bought it so that I could, like, bring it to my home and get it installed, and afterwards I can use it up. And for the delivery, I ended up paying like $80, for example. So according to the standard, the definition of the cost is going to comprise all the expenses which I am incurring now from the start, that is, from buying the non-current asset to its ultimate usage. When the AC is being delivered to my premises, obviously it is still packed. I have to get it installed so that I can use it up. Afterwards, I pay for the installation charges. For example, they are for $150. Afterwards, like, when the AC gets installed, then I have to go for the specialized switch or a specialized wiring which is required so as to support the AC to work. For example, if I need a specialized switch or I need a specialized wiring without which I won't be able to use my AC or I won't be able to use my AC, that cost for that specialized wiring or that specialized switch will be capitalized as well. And that is if I go for any switch, for example, that's $50. Afterwards, now my AC is ready for use and I start using my AC. This is the total cost over here, which is going to be capitalized now. And if I talk about the AC, obviously, if I say here, matlab, what is the total cost which is going to be capitalized over here? This will be a total of like, 1,280 $1,280. This is the total cost of the AC, which will be capitalized according to the definition. So this is something we have to keep in mind, and that is whenever we are talking about a non-current assets cost, we have to keep it in mind that the expenses which we incur in buying or constructing the asset, the expenses which are being incurred will be capitalized in its cost. Now moving ahead, we'll look towards a refined example now, because we have to discuss some points over here as well. And that is, for example, now we are taking an example of importing a machinery. We are importing a machinery from overseas and we have to get it installed in our factory, and for the use or for using the machinery we are now planning to import it up. Over here the costs which will be capitalized are going to be as follows. Obviously, first of all, is list price will be capitalized, excluding trade discounts and refundable taxes. The list price along with, wait a second. Okay, so now the list price will be capitalized and we will be excluding the trade discounts and the refundable taxes. Now, from our prior studies, trade discounts, the discounts which are available on the spot, or the discounts which we get through some discount policies of the the seller, or the discount we can call it as a bargain discount as well, which we get during or at the time of the acquisition of the asset. It's called as a trade discount, and we do not record the trade discount in our books. So we will be excluding the trade discount from the list price. That is, for example, I'm writing over here, the cost of an asset is $10,000. Then the cost of the asset is $10,000, and supplier is offering a 10% discount. Suppose the cost of an asset is $10,000 and the supplier is offering a 10% discount, which means if you buy the asset, the supplier is going to give you a 10% discount, which means if we solve it over here, we get a discount of 1,000. So technically, the journal entries which are going to be passed if you buy this asset is obviously the asset is going to be debited with 9,000 and the cash is going to be credited with 9,000, because asset will be debited because it's an increase in asset, and on the other hand, the cash will be credited because this is a decrease in asset. So technically, what we do over here is that we are excluding the trade discount which is being offered to us from the supplier. Similarly, this is the point which I was discussing over here on this point, that the list price of the asset will be capitalized and we will be excluding the trade discounts. And similarly, if we have paid any amount in the form of a tax, and if we have paid any amount in the form of a tax and that tax is refundable, that tax is refundable from the government, then again we will be excluding that tax from our list price. That is, if we are paying a tax, like similarly, like just like the sales tax or any of the VAT which is being paid, like during the acquisition of an asset, and that VAT or a sales tax or any other tax in the form of any tax, if that is refundable, then obviously we will be excluding that tax from the list price. Afterwards, we get, obviously we are importing a machinery, which means that we have to, like bring it into our country, which means we have to pay the import duties. So the import duties which will be paid by us will be capitalized. We will be capitalizing the import duties, and this is the import duty is basically the amount which you have to pay to get your asset into your local country, or the local area where you are living. Then afterwards, when we pay the import duties, there is a, the rule for the international consignment, and that is that whenever you are importing any, stuff from outside the country and its value is like around $50 or more, you have to get it insured. My point is, whenever you are importing anything or you're buying anything from, the other country, then the rules of the international consignment are basically that you have to get it insured. Now we are paying any amount as an insurance cost, and for the insurance cost, now we have to discuss we are paying any amount as insurance cost, and now we have to discuss that will it be capitalized, will it be added to the, value, or the amount of the non-current asset. This is the question now. What do you guys think? Should we capitalize the insurance cost or not? Should we capitalize the insurance cost or not? What do you guys think? Anyone? Ma'am, if you're speaking anything, we can't hear you.
I think yes, we should capitalize.
No, it's not a capitalize because it's an expense rather. Because insurance costs,
how do you categorize it as an expense?
Because we incur it almost every year. So it's an expense for the company.
Yeah, we incur it in every year. Okay, fine. But there are certain rules or regulation which the standard permits, which guides us about a certain expense to be categorized as an expense or as an asset, right? Because if we are incurring the import duties, they are an expense as well, right? Import duties are an expense itself, right? So we are capitalizing them over here because according to the definition of the the standard, that all the expenses being incurred in bringing the item of non-current asset to its present location, they should be capitalized, right? So according to the definition, the import duties are an expense, but we are capitalizing them. Your answer is correct. Let me clear you over here that you said insurance cannot be capitalized. It's an expense. I agree. We cannot capitalize it, but there is a logical explanation behind it, that why don't we capitalize the insurance? I'm trying to take you guys over, like, onto that point.
If we don't pay the insurance, because it will not be in the present state to be used, that's why we should capitalize it.
Okay, now you're saying, okay, if we don't pay the insurance, then obviously we can't get our equipment to the, like, the required place we are getting, like,
Yes.
where we actually. Okay.
Yes.
Okay, I get your point. I get your point. Okay, now listen. Uh, whenever we are talking about capitalizing a certain amount, it means we are by default saying that it should be capitalized and it should be categorized as a non-current asset. Let's leave the word non-current to a side for a second and let's focus on the word asset. What is an asset? By definition, when we say, and when we go for the definition, when we say, according to the definition of the asset, it says that when it is probable that economic benefit will flow towards the organization. What's the definition of an asset is? When it is probable, that is, when you are more than 75% confirmed, when you are more than 75% sure that an economic benefit will flow towards the organization, then it's called an asset. When you are more than 75% confirmed that you'll get an economic benefit from a particular thing, then it will be considered as an asset. So according to the definition, is insurance an asset? If we look at the definition and if we talk about it, is insurance an asset? The very first question which comes in our mind. And when the question comes, we answer that yes, we do try to get a benefit from the insurance. That is, if anything, like, happens to the asset during the transit, or like, if any bad event happens during the transit, obviously we will be getting a total 100% refund, or we will be getting a brand new asset in exchange of that. Obviously, whenever, like, we buy a car, we get it insured so as to avoid any, like, unfavorable future event. We get our car insured because in case of an accident, in case of a theft, or in case of any damage, the insurance company will be paying for the damages or for the new car. This is what we always have in mind. But there is a specific word which we always say, and that is, if anything goes wrong, if anything happens, if any unfavorable event occurs. The word is if. That is not, like, if, that is kind of 50-50. How many of we sitting over here claim the insurance of our car every year? How many of us have heard that the, like, merchant navy ship, like, got drowned, and then, like, a plane crash, like, consignment of the goods? Very rare, right? Almost near to zero, because the air travel is still considered as the safest in all forms of travel. So technically, for an asset to be recognized as an asset, the definition says that you have to be more than 75% confirmed. You have to be more than 75% insured. Only then you can record it as an asset. However, when we talk about the insurance, we see that we are always saying, if this happens, then there is this solution, or if that happens, then we have a solution. We are continuously saying the word if. That means we are not confirmed, we are not sure that whether we will be getting the benefit from the insurance expense or not. This is the point over here. Because, like, what if the consignment comes safe and sound? Then obviously the amount which is being paid for the insurance has been lost. Obviously, we won't be getting any benefit from it. It will be, like, flushed out as an expense. So we cannot, or we can never, like, capitalize the insurance as a asset. Then moving ahead, we are now installing the asset, so we are paying for the installation cost. Let me fix it for a second. I don't know why this is giving me a hard time today. Let's set it. Okay, so we were talking about the installation costs. Installation cost, that is obviously when you get your asset over here, into your local area or something, obviously you have to get it installed. If it's a big machinery, obviously you will have to get it installed. The installation cost will be capitalized, obviously. Then moving ahead from the installation, you have the training costs now. What is the training cost? Anyone? Training cost. What's the training cost? Okay, you guys are sitting silent, means either you guys know, either you guys don't know. Anyhow, the training cost is basically when you train your employees for a specific task, or you train them within the organization about any new rule, or new event or anything. That is a training cost when you train your employees to do a specific task into in a best possible way or in a best possible manner. So when you get a new machinery or you get a new plant, obviously you have to train your employees for you have to train them regarding how they are going to use the asset. Now the question comes, will the training cost will be capitalized, or can we capitalize the training cost or not? This is the question which we have to answer. What's your say in it? What do you guys think? That should we capitalize the training cost or not? We can't hear you, ma'am.
Hello? Yes.
Anyone on the training cost? Any idea about should we capitalize it or not?
It should be categorized as an expense rather than consider it as an asset as part of the machinery.
How? Can you elaborate your point something? Somewhat can you give me an idea, or by some example or something?
Actually, because training, we are incurring training costs because it is something that we are going to bring into the company for using for usage of the machinery.
Mm-hmm.
Yeah, and each year we do have training. We receive training, so for me it will be an expense.
So here it's an expense. Okay, but overall, if you talk about the training, if you talk about, or if we take an example of the new machinery, if you talk about that, if you obviously don't train your employees, then, or if you don't get them trained on the machinery, they won't be have an idea about how to use the machinery, right? You getting my point? If we don't
Yeah.
train our employees on how to use the machinery, then how will they use the machinery if the asset is available for use but they don't know how to use it?
Yeah, it's true. We'll need to give them the maximum training so that they can deliver on the job as well and use the machine correctly.
Mhm. So should it be capitalized now or not?
Yeah, we need to capitalize it.
Okay. Now, let's move to another point. If we talk about the training, what's training? That is the experience or the knowledge that a person gains, right? Let's take an example of a car. Let's assume that I and you, we both buy a brand new car. Now, you know how to drive. You take the keys, you sit in the car, you start the car, you put it into the gear, and you move out, right? You easily drive away with the car. But me, on the other hand, I'm standing outside the car, looking at the key, looking at the car, and thinking about what to do, how to drive it. I have to train myself via instructor or something to get trained myself on regarding, like, on how to use or how to drive the car. It is me who needs the training. It's not the asset, it's not the machine which needs the training. And on the other hand, if we talk about the training, this is the asset, or this is an intangible asset of a person. The machine is ready for use. When we bought the machine, we got it installed over here. The machine is in the premises. It is ready for use, but it is the, the workers who needs to be trained, who needs to know how to use the machine. Right? In detail over there as well. But just for the sake of the knowledge, this is something I'm discussing over here. And that is, training is an intangible asset. It has the same recognition criteria, just like an ordinary asset, that the future economic benefit should be probable, it should be controlled. But for the intangible asset, there is one additional point, and that is intangible asset from the should be separated from the entity. If you have to recognize variable, then it cannot be recognized. We can't separate our knowledge self, because if we take away from our of away our share your experience in the book, but again, by sharing your experience will never be lost. It will be you, because some leave behind the quote, or they were. So we're discussing that, mating is not code find this cap or the code for where, and we, to be automatically trained. So training is not for the,
Sir, we
so
are
we
having
cannot capitalize
connection
the
problem.
training cost. Can you guys hear me clearly? Or
It's a very bad connection, so I'm not hearing you
okay,
properly.
let me get it fixed. Let me get it fixed. Please hold on for a second. Let me get it fixed.
Yeah.
Can you guys hear me now properly?
It's clear now. We can hear you properly.
Okay, so we were discussing the training cost. So by summing up this, the simple rule of thumb is that the training cost cannot be capitalized because we are not probable from the future economic benefits of the training, because we cannot control it technically, because you cannot control your employee. You cannot have a control over him, because you can watch your employee, you can monitor his or her performance, but obviously you cannot you can say you cannot control him, because you cannot control a human being. See, so therefore we cannot capitalize the training cost, because the element of the training, element of the control and the separation is not available over there. Moving ahead from the training cost, we come towards the first testing cost. Now, if we talk about the testing cost, what is the testing cost? The testing cost is obviously when you install your machinery into your premises, you have to do some test, or you have to do some test printing, or you have to do some test production, so as to ensure that the machine is producing or is manufacturing the product as was required by you in terms of quantity, in terms of quality. Because obviously it's a hardware, it's a machine. It's not necessary that after assembling it up, it's not necessary that it is going to give you its performance which is being claimed by the seller, because obviously you have to tune it up, you have to set it up, you have to do some fine adjustments, so as to ensure that the machine is now giving you the output of the desired quality and quantity. So if we talk about the testing cost, here the standard says that all of the cost incurred in testing and adjusting the asset for production, that is the first time cost. First time you incur as much as cost you want to, until and unless you don't get the desired quantity and quality, and you don't get your sample approved from the production and the quality department. You can incur as much cost as you want to. But once the production or the sample is being approved by the quality control and the and the production department, and they allow the machine to be used for the commercial production, then the testing cost stops. That is, you have installed the machinery in your premises, you run it for like 2, 3, 4 times, do some fine tunings, do some fine adjustments, and then afterwards you start getting the desired quantity and quality which the seller of the machine committed with you. Now, the production and the quality control department has approved that sample and they say now the machine is fit for the commercial production. Up till that point, all the cost that was being incurred in the name of the testing can be capitalized. The standard permits, because the definition says, and the cost incurred so as to bring it to its intended use, and the expenses incurred so as to bring it to its intended use. This is the line. This is the line now we are discussing. This is the point we are now focusing on. That the standard says that if the machine or an asset is being installed and it is tested for the first time, then you can easily capitalize it. Now, there comes in an extra point, and that is, same case, you incur around, same case, in terms of material and labor, you incur around $500 as testing cost or as first testing cost. Obviously, the materials which you manufactured are not up to the mark. They are not up to the quality that you normally offer to your customers. Now, if the product which is being manufactured or assembled over there in your premises with this machinery, if obviously they cannot be sold properly into the market, can they be scrapped, or can you dispose of them against a certain value? If no, there is a zero cash inflow as far as from selling those unfit or not up to the mark quality products. If you can't sell them off, it's fine, you can capitalize all of the $500 as your testing cost. If you cannot dispose of, you cannot sell off those kind of substandard or not up to the mark or not up to the quality products into the market, you cannot sell them, there's no point of, or there's no way you can sell them in the market, then the $500 which is being incurred as a testing cost, it will be capitalized in full. This $500 which is now being incurred as a testing cost, it will be capitalized in full. But if you can dispose of those items at any rate, at any nominal rate available to you guys into the market, for example, I dispose of them, yeah, I get disposal proceeds from them for like around $100 maximum. This is the disposal proceeds which I get from them. Then what I'll do is I will deduct this $100 from it, and I will capitalize net cost of testing, and that is $400. What I'll do is that if I can dispose of them in the market at any rate, that is I'm getting these I'm just saying maybe I'll be able to sell them off for $100 or something. What I'll do is I will deduct this $100 from the 500 cost, that is of the cost of testing, and I will get a net amount of $400, and I will be capitalizing that $400 in my accounts, or in my the total cost of the non-current asset. This is what basically the initial cost is. What you guys have to do is you guys have to focus on what your initial cost is. And this is how actually, when you look at some costs, this is how basically you guys go on and you guys you can capitalize these costs. Now, moving ahead from the initial measurement, the next step is basically subsequent expenditure. Subsequent expenditure is that is once you have capitalized the costs, afterwards you go on and you incur any expense on that asset. First, we have discussed what a tangible non-current asset is. Then we discussed how do we capitalize a non-current asset, or at what value. We discussed we capitalize that non-current asset on its cost. Then we discussed what the cost is. Now we are discussing, or we are about to discuss what a subsequent expenditure is. Subsequent means afterwards. Subsequent expenditure, any expense that you incur on the non-current asset afterwards. Now, if you incur any expense on a non-current asset which enhances its performance or increases its useful life, you incur costs on a non-current asset which enhances its performance or increases its useful life, such expenses will be capitalized. Such expenses will be added to the cost of an asset. For example, you incur a cost on your asset due to which its performance enhances, due to which its capacity increases, or performance enhances. Such a cost will be capitalized. For example, you have a machine which uses a motor, and the motor is being used, or that component is used for the speed of the machinery. For example, currently the machine has an output of 100 units per hour. For example, at the moment, the machine has an output of 100 units per hour. Now, afterwards, what you do is you incur such an expense on that machine that the output now increases from 100 to 120 and or 130 units per hour. Currently, the machine is producing or manufacturing 100 units per hour. You incur an expense on that particular machine, and the machine starts manufacturing 130 units per hour. There is an increase of 30 units per hour. Obviously, the performance has been enhanced. Such an expense will be capitalized. This is what the rule of thumb is. That if you incur a cost, and because of that cost, if the performance of the asset is being enhanced, the performance of the asset increases, that expense will be capitalized. Or similarly, you incur such a cost on an asset because of which its useful life increases. You incur such a cost on an asset that increases its useful life. For example, at first it had a useful life of 10 years, and after incurring expense on an asset, the useful life has been increased to 15 years. From 10 years, it increased to 15 years. Such a cost will be capitalized as well. So these two expenses, if incurred, will be capitalized. Otherwise, if there is a repair or maintenance of the asset, if there is a repair or a maintenance of the asset, obviously it will not be uh, it cannot be capitalized. If there is a repair, there is a maintenance of the asset, it will be categorized as a revenue expense. If you are going for the repair or the maintenance, or if there is a change of or the replacement or the part replacement, it will be categorized, or it will be considered as a revenue expense. Then afterwards, moving ahead from subsequent expenditure, we go for subsequent measurement. First, we have initial measurement. Now we are talking about the subsequent measurement. Subsequently, all non-current assets can be measured by using any of the two following models. We have two models in International Accounting Standard number 16 to value our non-current assets. The first one is the cost model. The other one is the fair value model. These are the two models which we actually use to value our non-current assets, and this is how we measure our non-current assets. If we talk about the cost model, we can say the asset is reported at its carrying value. We are now saying the asset is reported at its carrying value. And carrying value is basically cost minus accumulated depreciation. And now this depreciation. The word depreciation means decrease in value, that is the wear and tear. If there is a decrease in value, there is a wear and tear. This is being regarded as the depreciation, and the standardization definition which we have for the depreciation is basically it is the systematic allocation of the cost of an asset to income statement according to its usage on a pro rata basis. Depreciation is basically it is a systematic allocation of the cost of an asset to income statement according to its usage on a pro rata basis. That is the depreciation. When we say it's a decrease in value, or like either it's a wear and tear or something, it is because that when we use the asset and obviously by the use its value decreases because it's not new anymore and there's a wear and tear in the asset, so we call it as a depreciation. And according to the definition of the depreciation, this is such a systematic way. This is such a way by which we keep on charging the cost of an asset to income statement according to the way by which we use. And that is basically we have, if we talk about methods of calculating depreciation, we have two methods basically. If we talk about this, one is straight line method, the other one is the reducing balance method. If we talk about straight line method, we have two ways by which we calculate the depreciation in straight line. One is cost minus scrap value divided by useful life. You get a fixed depreciation charge per year for every year. And the other method for straight line is basically cost minus scrap value into percentage of depreciation. And then again, you get the fixed depreciation charge per year for every year. Now let's take a look at an example. Suppose you buy a plant, yeah, you buy a machinery for $100,000 having a scrap value of $10,000 and a useful life of 10 years. How the asset will be depreciated over the years. Now, this is an example which we are looking for the straight line depreciation. Now, there are two terms which we need to discuss over here. One is the scrap value, and the other one is basically the useful life. If we talk about, like, the scrap value, this is the value at which management expects to sell the asset at the end of its useful life. Scrap value is basically the value or the estimated value which the management expects to sell the asset, or at the value which the management expects to sell the asset at the end of its useful life. It's an estimated value. It's not an exact figure. For example, if you buy an asset today and you expect that after using it for like 4 or 5 years, you will be able to sell it off for like around 2,000, 3,000. This is just an estimate. If you can do an estimate, like, while selling off an asset, if you have a reliable estimate and you can judge or you can think because of your past experience that we will be able to sell off this asset at this value, then it's fine. You can consider it, or you can, like, record this scrap value into your books. If you are unable to judge, you are unable to guess, you are unable to reliably calculate here what will be the amount at which we will be selling the asset, then it's okay. You can take it as a zero. If you are unable to calculate at what value you will be selling off your asset, if you are unable to calculate or judge what will be the value of the asset at the end of its useful life, then it's fine. You can take it as nil, you can take it as a zero. And then when we talk about the useful life, what's a useful life? This is basically the time period over which the asset will be used. Again, this time period, this useful life is obviously is again an estimate which the management does. Normally, the accounting provides us, or the international accounting standards help us to determine the or estimate the value, or sorry, not the value, but the life of the assets basically. The management the accounting standards basically guide us about what can be or what should be, or what is the estimated life of certain few assets. For example, if we talk about the automobiles, if we talk about the the cars, the estimated useful life is being given by the accountings basically the 5 years. If we talk about the bikes, the life is 3 years. For all the electronic gadgets, the life is 3 years. So this is something, a standard guidance is available. But again, if you think that your asset will be used at a life which is plus minus to the guided one, or which is a plus minus to the one being given or being guided by the standard, you can have that useful life into your accounts as well. You can go for that, and you can revise the useful life as well. And we will be looking at the revision, at the examples of the revision of useful life in a while as well. We will be doing such examples as well. So now we looked at an example, and the example is, suppose you buy a machinery for 100,000 having a scrap value of 10,000 and useful life of 10 years. How the asset will be depreciated over the years. If you take a look at this example, then the simple solution over here is basically if we use the straight line method of depreciation, its formula is cost minus scrap value divided by useful life. If we solve it over here, 100,000 minus 10,000 is the scrap value, and useful life is 10 years. Obviously, we'll be getting 9,000 per year depreciation charge. And this 9,000 depreciation charge is fixed for all the coming 10 years. Because in straight line method, what we do is when we calculate a depreciation charge, it normally remains the same for every year. This is the rule for the straight line method. Okay. And if suppose we had an example over here, same example, this is the same example that suppose I have to give it as example 2, and what I have to change is, and a useful life of 10 years, what we'll do is, okay, the asset will be depreciated at 10% per annum on cost. Now, this is a change, or this is a, like, a different requirement than, like, the past one. What we will do is here, this is the same, the answer will be same just like the previous example, but I'm telling you, or I'm giving an example just to see that if the question has given you the percentage instead of the years, then how do you solve? This is the second one which we are going to use over here now, this one. See, this is the example now we are going to get and use. 100,000 minus 10,000 scrap value, we get 90,000 carrying value into percentage of depreciation of 10%, we get again 9,000 per year. Same, just like before as we did earlier. This is again like 9,000 per year. That is 100,000 minus 10,000. We get a carrying value of 90,000. And then we have to take up the percentage that is of the 10%, and we get a $9,000 per year as a fixed depreciation charge per year. Moving ahead, now let's talk about the reducing balance method. Reducing balance method says cost minus accumulated depreciation is equal to carrying value. You multiply the percentage of depreciation with the carrying value, and you get depreciation charge for a specific year. You get a depreciation charge for a specific year. For example, if you look at an example over here, we can see that suppose an asset is bought for 100,000. It is decided to depreciate the asset at 10% per annum using the reducing balance method. How the depreciation will be charged. Now, if we look for the year one, we already know that this is the whole formula that we will be using. I'm erasing this from here. Now, if you look in year one, we have a cost of 100,000, but accumulated depreciation is 0 in year one. Why? Accumulated means to accumulate, to gather, to sum up. Now, What a depreciation is, that is obviously, as we have read earlier, that this is the charge that we will be charging to the income statement according to the use of the asset, right? Now in year one, the asset hasn't been, or asset was not available for use beforehand. We just got the asset. This is now the end of the year one, and this is the first time that we will be charging the depreciation on it. Okay? There is no depreciation charged on it beforehand, right? We don't have a depreciation balance. We don't have a depreciation on that particular asset beforehand. So technically, the accumulated depreciation will be zero. So we will be having a carrying amount of 100,000, because 100,000 minus zero is obviously 100,000 into percentage of depreciation of 10%. We get a 10,000 depreciation charge for year one. For year one, we get a depreciation charge of 10,000. Then moving to year two, we have a cost of 100,000 minus accumulated depreciation. Accumulated depreciation means all the depreciation that has been charged earlier. Now, what depreciation or the balance we have over here is, that is 10,000. We get a carrying value of 90,000 into 10%. That is the depreciation charge. We get 9,000 depreciation charge for year two. If we move ahead towards year three, we have 100,000 minus. Now look at the accumulated depreciation balance. 10 from year one, 9 from year two. Total is 19,000. We get 81,000 into 10%, and we get a depreciation charge of 8,100. This is a reducing balance method. The balance is basically the reducing. See, the depreciation charge every year is reducing over here. This is what the reducing balance is. This is how you charge for the reducing balance. Now, if you guys have any question, please feel free to ask. Are you guys copying up, or are you guys getting the points which we are discussing over here? If you have any question, please feel free to ask. Or if you guys want to ask anything, please ask. Because if you guys don't speak, or if you guys don't discuss or ask any question, I won't be able to know that if you guys are getting along with me or not. So please tell me if you guys are getting all the points as we are discussing. Or if you guys want to ask anything, or if there is any question in your mind related to the the depreciation or any of the methods or the things which we discussed earlier, you guys can ask.
All good for now.
Okay, all good for now. Anyone else? Okay. If one of the students is saying that it's all good for now, and then it means, and I hope that it's good for everyone else as well. And please feel free to ask if you have any question, or if you have any query, or any example. If you want to go to ask, you guys can ask, because this is a two-way process. We if you guys are sitting over here over one particular thing, then the main aim is to get something out of it. You guys, obviously, by spending all of the day, then coming over here for the class, obviously it's a hectic one for you as well. But at the end of the day, if you guys don't ask, or if you guys don't raise questions, or raise questions in the context of if you guys are not getting anything out of investing this time, then there is no point of having this meeting as well. What you guys have to do is come up with any of the question or any practical question which you have in your field. If you have any problem over there as well, the live example, you can ask us. You can ask those examples. We can discuss those examples over here as well while doing our work. Because the thing is, the main point or the main aim is to get something out of this meeting. And that's something, obviously, while covering the syllabus of the F7, that's something that is the best benefit you guys can have from this all, the arrangement. Because we while me working over here, because we had a year end at the 30th June over here in Pakistan as well. So obviously, while being engaging with the firms and all, or while we doing the audits and all, there are so many cases which we come across every day now and then, that we have already somehow some way have already discussed or have already done such examples in the class as well, which makes our study easy. So this is why I'm asking you guys, if you have any question or if you have to ask anything, you guys can feel free to ask. There is no issue with that, and I won't mind any questions, obviously. Okay, now moving ahead, we talked about the straight line method. We talked about the reducing balance method. Now what we are going to do is we are going to talk about the revision of useful life. If we talk about the revision of useful life, okay, one thing to clear, I will be providing you the proper handouts and the proper notes. What I am doing right now on the Word file is basically I'm kind of using the whiteboard. If I would have been in the class, I would have been using the whiteboard like this. So at the end of the day, you will be having the proper notes related to the standard, so that you can easily go through them, you can easily see them. Meanwhile, in the class we will be discussing some short examples, and after a while, after covering a bit of the standard, we will be doing a comprehensive question from the exam kit as well. So from day one, we will be discussing the exam kit as well. What I'll do is I'll send you the questions somehow, and obviously after you guys get the question, we will be doing that question as well in the class, within the class today as well. So we were talking about the revision of useful life. What the revision of useful life is, at the time when the management thinks at the start that the asset had a particular useful life, and then the management decided to revise its useful life, either increased it, either decreased it, then what's the treatment? How are we going to account for the revision of useful life into our accounts? Let's take an example, similarly like the previous one which we had, that for example, the company purchased a non-current asset for 200,000 with a useful life of 10 years. After 3 years, inspecting the non-current asset and considering its working, the management decided to revise its useful life to 9 years to 4 years. How requirement? How the revision of useful life be reflected in the accounts? Okay, how are we going to reflect the revision of useful life in the accounts? The company purchased a non-current asset for 200,000 at the useful life of 10 years, right? So now, if we talk about this asset, the company got it for 100,000, life of 10 years. And after 3 years, inspecting the non-current asset and considering its working, the management decided to revise the useful life to, now we have the number of years. Now, what we have to do over here, the very first point is, whenever we are looking at a question of a non-current asset, the point which is to be considered or point which is to be noted is that we have to make sure that we have the carrying value of the asset under consideration, we should have its carrying value of the same particular date or on the same date on which the whole of the scenario is being discussed. That is, like over here, the question says after 3 years inspecting the non-current asset. It means first we have to calculate the carrying value of the asset after 3 years. What is going to be the carrying value of the asset after 3 years? First of all, we have to calculate it that. Step one, calculate the carrying value of non-current asset at the end of year 3. That is 200,000 by 10 years, up 10 years being the life, you get 20,000 per year into 3 years, you get $60,000 as accumulated depreciation. So the carrying value of the asset is equal to 200,000 minus 60,000 is $140,000. Now we have calculated the carrying value of the asset up till the time that the scenario is now discussing. Okay, now the management has decided to revise its useful life to 9 years and 4 years. Over here, the remaining useful life is 7 years. But in first example, the management has decided to revise its useful life to 9 years. Now, whenever we have to incorporate the change in estimate, remember, always remember, the change will always be perspective. Perspective means from now onwards. Perspective means from now onwards. You will be looking from now onwards. It means whenever there is a change in the revision or there is a revision of useful life, you will incorporate that change from now onwards. You won't change what has been done in the past. You won't alter the accounts for the past years. You will incorporate this change from now onwards. That is for year 4, the depreciation charge will be, that is, remaining carrying value divided by revised useful life. Remaining carrying value divided by revised useful life. Now, what's the remaining carrying value, by the way? We have already calculated, and this is 140,000. So 140,000 is going to be divided by, remaining years are 7, right? So 140,000 by 7, we get 20,000 per year depreciation charge. This is what we are going to do. Whenever there is a change in or revision in the useful life of an asset, we are going to go for a perspective change. Perspective changes from now onwards. From now onwards, you have to incorporate this change. And that is, you have to incorporate in such a way that you won't alter the accounts which are being done or which have been prepared in the past. But what you have to do is, you will uh, account for the change in the current year when the change is being considered, or when the change is being required by the management to be implemented. From current year onwards, you will apply with this change. And that is, you will divide the remaining the remaining carrying value of the asset with the revised useful life. Similarly, if we look at the second revision, and that was on 4 years. In first previous example, we saw that the revision was if we talk about the revision, it was for the 9 years. Now, in that example, the life of the asset was being increased. The life of the asset was increased. Now, for this, in this example, the life of the asset is rather decreased. So if we talk about this, what will be the calculation or how the calculations will be made? It will be a remaining value 140,000 by 4 years. You get 140 by 4 is 35,000 per year depreciation charge. This is what you get. This is the 35,000 depreciation charge per year if the remaining life of the asset is only 4 years, and if the remaining life of the asset, okay, this is something we done. There's a little error over here. At first, the management decided to revise the useful life to 9 years. We have written the 7 over here. This is the mistake over here. It should have been on 9 because the years were revised to 9, right? So this is something nobody pointed it out to me as well from you guys. Okay, this is going to be 15,567. This is going to be almost 556. This is going to be 556. Yeah, this is going to be the answer. 15,556 per year as a depreciation charge. This is what you get if you revise the useful life to 9 years, and if the life of the asset is revised to 4 years, that the remaining life is shortened to 4 years, then the depreciation charge will be 35,000 per year. See, now these are the two things which we did. If the life of the asset is revised to 9 years, what we will do is we will divide the remaining carrying value with the revised useful life. Either it increases, either the useful life increases, either the useful life decreases. The rule of thumb is we will be simply dividing it with the revised useful life. Now, if we move ahead,
Sir,
yeah.
I've got a question. Yeah, I've got a question. Can you move upwards? Yeah, here. For year 4, or should it be for year 9? The depreciation charge will be 140,000 over 9. Should we not say for year 9, the depreciation charge will be instead of 4?
For year 4 means for year 4. That means the 3 years have passed. 3
Okay.
years have passed, right? This is the year 4. Fourth year, when you are doing the accounts or when you are preparing. This is
Okay.
the fourth year of the assets life. This is not the year 4 means the second part. This is not that. This 4 years, this is being solved separately over here. This, what I'm saying, is for year 4. Year 4 means 3 years have been passed for the asset. See, what we have written over here, calculate the carrying value of the non-current asset at the end of year 3. 3 years have passed. Now for calculating the depreciation of year 4, what you will do is you will divide the remaining carrying value with the revised useful life, and that is 9 years.
Okay, got it. Thanks.
Okay, no problem, no problem. Okay, moving ahead from here. Now what we have to do is we have to keep in mind the journal entries as well. As far as recording depreciation charge is concerned, you have already studied in your F3 as well that we debit the depreciation expense and we credit the accumulated depreciation, right? And afterwards, when we are preparing the accounts, in statement of comprehensive income, depreciation expenses transferred and closed, we deduct the depreciation expense from there, and in statement of financial position, we write the assets cost minus accumulated depreciation. We write technically the assets carrying value over there. We write the assets carrying value over there, right? This is basically the standard depreciation double entry which we pass. Now, if the organization is not maintaining the accumulated depreciation account separately, it is only maintaining a carrying account, carrying value account. If the organization is only maintaining a carrying value account, then the entry is going to be depreciation expense debit and asset credit. Net effect at the end is same. It's about how you are maintaining the accounts. If we talk about the accounts, then how are you basically maintaining the accounts? This is just that. Okay, now I have to open the Excel just for the accounts. I have to make some T accounts for you so that you guys do get an idea about how the accounts are being moved. Let me open the file and then I'll share it with you guys, and I'll show that how do we prepare the accounts in Excel as far as the T accounts is rather concerned. Okay, so here we have Excel. First of all, we have assets cost account. I hope it's clear and it's not. Okay, let me just clear it for you. Okay. We have the currency signs over here. Then we have balance brought down from the last year. Then we have acquisitions during the year, which we do. We have disposals over here, and then for now, up till the level we have covered. Obviously, we will be amending these again in a short while after studying the fair value model. This is the balance carried down we get. Now acquisitions during the year, that is basically the plant and equipment which basically we buy during the year. They are being classified as the acquisition, because in terms of the accounting, when we purchase a non-current asset, we call it as we acquired the non-current asset, or the acquisition of a non-current asset took place. We don't call it as we purchased a non-current asset. We don't say like that, because we use accounting terminology for that purpose. As far as the acquisition is concerned, the double entry for that will be asset account debit, and I'm writing debit over here, and credit is going to be either cash or the payables. Like if you're paying the cash, or if you are getting the credit, it will be the payables. As far as the disposal is concerned, whenever we sell off, or whenever we sell our non-current asset, we call it as a disposal, again in accounting terminology. And for disposal, the double entry is going to be debit disposal account and credit asset account. What we do is we eliminate, or we deduct all of the assets cost from the cost account whenever the asset is being disposed of, or whenever we dispose of our asset. Okay, now moving ahead, this is going to be another account. Okay, this is the accumulated depreciation account. We have obviously the currency signs here, and then the currency signs here. This is the opening balance. Similarly, we have closing balance. This is the depreciation charge for the year. And we have this, and then we have over here disposal again. For the depreciation charge for the year, we have already studied the double entry. Debit is going to be depreciation expense, which will be transferred to the income statement or the statement of comprehensive income. And credit over here is the accumulated depreciation account. For the disposal over here, we have the double entry as debit disposal account and credit the debit is going to be accumulated depreciation account and the credit is going to be disposal account. And now moving towards the disposal account. What is a disposal account? That is what's this name or what's this thing which is we are kind of sort of discussing again and again. Okay, if we talk about the disposal account, we have assets cost here. We have its accumulated depreciation here. Then we have its cash proceeds. And then we have the balancing figure, either here or either here. And this balancing figure basically represents statement of comprehensive income. If the balance over here, if the balance is on the credit side, then it means it's loss on disposal. And if the balance is here, then it means that it's profit on disposal. If we have the loss on disposal, the entry is going to be debit statement of comprehensive income, and credit is going to be disposal account, because we are crediting over here, no? We are balancing it off. This is with the loss of disposal, which will be deducted from the statement of comprehensive income. And similarly, if we have the profit on disposal, the double entry is going to be debit disposal, credit statement of comprehensive income, and we are going to add the profit on disposal. This is something which we are going to do over there. For now, what we have learned or what we have studied is basically based upon these accounts, and we are making these accounts on that only, the topic areas, or basically the area which we have covered so far. This is basically what we have learned so far, or these are the things which we have discussed so far. Okay, now moving back to our work, we were over here. Achha, if you have any question related to the T accounts, you can ask. If you have any issues, or if you want to look into anything, you can ask. Or if you want to discuss any of the accounts, you can ask as well. Okay, it means it's clear. Okay, moving ahead, we were discussing, if we come back towards our notes, see, we were over here we were into the subsequent measurement. where we discuss, we have two models, the cost model and the fair value model. The cost model, we had to report the asset at its carrying value, right? We reported the asset at its carrying value. Then we had, for the carrying value, we read the formula cost minus accumulated depreciation. Then we learned or read about the word depreciation. Then we discussed what the depreciation is. Then we discussed how to calculate the depreciation, either via the straight line method or either via the reducing balance method. Then we looked at some examples. Now moving ahead from it, now we have the second model, and that is, we have to revise it. The fair value model. What the fair value model states, the asset is reported at its fair value. Now, the question comes, fair value. Any idea about what the fair value is? Any one of you? Any idea, any guess what's the fair value is? Anyone? Come on, you guys have to speak up. Any general term, general idea. I just want to make sure that you guys are up and not sleeping. That's it. That's why I'm just asking. Come on, give me your input so that I know that, like, I'm not talking to, like, the names, the persons are sitting, like, at the back end as well, and they are, like, kind of trying to study. Just give me an idea about the fair value.
Fair value is based on the market value of the asset.
Can you please a bit louder?
Fair value is the amount of the asset based on the market value.
Fine. Actually, I'm unable to hear your voice properly, but I got an idea from you. Fair value is basically the value at which an asset could be exchanged or a liability settled among knowledgeable, willing parties in an arm's length transaction. Okay, the fair value is the value at which an asset could be exchanged or a liability settled between the knowledgeable willing parties in an arm's length transaction. That is, fair value is basically the value at which we normally exchange an asset, or we can exchange an asset, or we can settle our liability. Meaning, fair value can be market value. Fair value can be a market value as well. That is the market value. What's the market value? The value at which the product is available in the market, right? The value at which the product is available in the market, or the list price at which the product is available, is being regarded as the market value. But it's not necessarily that the market value can be a fair value. Fair value is basically the value at which you can exchange or buy an asset between knowledgeable and willing parties. This is the crucial important point here, that both the parties should have the knowledge about the value, or, like, the assets value, or they have an idea about which, like, the asset is going to be traded at something, and then they have the option to settle the liability as well. And in an arm's length transaction means the buyers and the sellers are readily available in the market. For example, uh, you buy a phone for yourself. You buy a phone for yourself. Now, same case, there are number of colors available in the market, but there is a golden color, for example, in which the phone looks superb, and because of its superbness, or because it looks so good in golden color, that everybody is literally buying the phone in golden color. So what happens? The phone gets short in the market. There is a short in the supply of the golden color phone in the market. So now, if a shopkeeper has that particular phone, now what he starts to do is he starts to sell it at a higher price than the market value. For example, if the market value of the phone is $1,500 for a normal phone, he is selling the golden color phone for like 1800. He is charging 300 extra for the golden color because it's his phone, right? It's his stock. He has the choice, like, at whatever price he wants to sell. So now you are about to buy a phone, but you want to get a golden phone. You don't want to go into a black, blue, or any other color. You want to get that particular golden phone. Now, when you go to that shopkeeper and you ask for the phone, the shopkeeper asks for the price of 1800. Now, if you buy the phone at 1800, that 1800 is going to be the fair value of the phone. That is, you are ready to exchange an asset. Obviously, you will give the cash, he will give you the phone. That is the exchange of asset, right? Between knowledgeable, willing parties. You have the knowledge of the market that the phone is available in the market at a price of 1500, but because of the shortage of that particular color, that phone is available for 1800. Now you have the knowledge about the market situation. You have the knowledge that if you get any other color, you can get the phone in 1500, but you are willing to pay extra so as to get the golden color. So this is the knowledgeable, and then the next point is willing parties. Willingness should be there as well. You can't point a gun at someone and ask for, to give you or to sell you their asset at your desired value. See, the willingness point is really very crucial as well. That the buyer and the seller, they both have to be willing, to do a transaction or get into, an arrangement of buying and selling, right? The willingness should be there. If one party is willing and the other party is not, then obviously it's not a fair value of the transaction. The fair value of the transaction cannot be determined if one party is willing and the other is not. See, the willingness is crucial as well. So now, when you are at the shop getting the phone for 1800 or $1800 or 1800 value, you are willing to pay for it, right? The shopkeeper is willing to sell it for 1800. You've got, both of you are willing for it, right? In an arm's length transaction, that there are other sellers in the market who are selling the product, and there are other in the buyers in the market who are buying the product. So technically, there is no shortage of the buyers and the sellers, and everyone is, willing to do the business. This is what the arm's length transaction is, and this is what the fair value is. Fair value is basically the price at which the transaction triggers. Fair value is basically the price at which the transaction triggers. This is what the point is. Now, again, this is a situation where we discussed we are ready to buy at a higher price. Now, let's talk about a situation where the fair value is less than the market value, or less than the, the asking price or something. Let's look at that example. For example, you owe money to your friend, right? You owe money to your friend. You have to pay like 500 to your friend. But because of your financial difficulties, you are unable to pay off your friend, right? Now, what your friend does is he asks for the money and he says that it's really very emergency. I need the cash. I have an urgent thing to attend to. Therefore, I need some cash. I need your help. I lent you $500, so it's now time that you should return me. And because of your financial difficulty, or like, because of any of the reasons, you are not being able to pay him off, so you say, look, I don't have 500, I want to help you as well, I want to return the money as well, but the thing is I don't have the 500 right now, I have 350 on me. If you are willing, I can give you 350, but in one condition. I won't be paying off you the rest of the amount. I will only pay 350. I won't pay a single penny in the future. If you agree, you can take the money from me, or else you can wait. Now, the situation is where you are trying to settle off your liability, and your friend is trying to settle off his account with you because you are his asset. So he's trying to settle off his account with you. Now, over there in this situation, the exact amount which owed was 500, but you are settling the account for 350. Or like in another situation, your friend says, look, I need the money, it's emergency, it's important, you pay me off only 400, I won't ask for the 100 in the future anymore. If you pay me 400, your account is settled, you don't have to pay me 100 more, right? This is what your friend suggests you. Now, the fair value of the transaction over here is just the $400. See, this is what the fair value is. This is what, like, how you actually, the fair value works. Or, for example, you have an asset with you, there is an emergency, and you decide to sell off your asset. Now you know that if you hold your asset, advertise it properly, and then sell it, you can have an extra amount. You can have the, like, the exact market rate at which your asset is worth for. But because of an emergency, you are willing to sell off your asset in a lower price. That lower price will be considered as the fair value of that asset, because that is the value at which the transaction is triggering, or that is the value at which the transaction is taking place. So this is what the fair value is. Normally, being a layman, we consider the market value as the fair value. We normally consider the market value as the fair value, but for a layman, we can say a fair value can be a market value of the asset, but it's not necessary for a market value to be the fair value of the asset, as we have discussed already in the examples which I discussed with you. So technically, we can say safely that a fair value can be a market value, but it's not necessary for a market value to be the fair value. This is something you have to remember at all times. Now, the fair value model says, or the fair value model suggests that you have to report your asset at its fair value. Let's take an example, or let's take a look at an example, and then we'll try to solve it accordingly. Okay. Suppose you bought a non-current asset for 100,000 with a useful life of 10 years. After 3 years, the asset is appraised as having a fair value of 90,000, 110,000. After 3 years, the asset is appraised as having a fair value of 90,000 or 110,000. how the fair value will be recorded in the accounts. Now, we bought a non-current asset for 100,000, useful life for 10 years, and after 3 years, the asset is appraised as having a fair value. One example is 90,000 and the other one is 110,000. Now, what we have to do is, again, just like the previous example, what we have to do is, okay, we have to calculate the carrying value of the non-current asset at the date of its revaluation or at the date of its the fair value. That means we have to calculate the carrying value of the asset for the exact date on which the fair value is given. Now, the fair value is given after 3 years. That is, again, from the end of the third year, the fair value is given. So in step 1, what will we will do is we will calculate the carrying value of the asset. And the carrying value of asset is going to be 100,000 by 10 years is equal to 10,000 per year into 3 is equal to 30,000 accumulated depreciation. Carrying value is going to be 100,000 minus 30,000, that is 70,000. The carrying value of the asset is going to be at 70,000. Now we will, in step 2, we will compare the fair value with the carrying value. We have to compare the fair value with the carrying value. In option 1, the fair value is 90,000. The carrying value is 70,000. So the increase of fair value, from carrying value is called revaluation gain or surplus. The increase of fair value, the amount by which the fair value increases from carrying value is called a revaluation gain or surplus, right? The amount by which the fair value increases the carrying value is called a revaluation gain or surplus. And over here we can see 90,000 minus 70,000 is equal to 20,000, and 20,000 is your revaluation gain over here, right? We have a gain of 20,000 over here. This is the revaluation gain, or this is the revaluation surplus. Second question comes in mind, rather this is the third question in mind, how to record revaluation gain. How do we record the revaluation gain? When we think about, like, how can we record the revaluation gain, or how should the revaluation gain be recorded? Because this is a gain, this is a profit, this is an income. One thinks that if it's an income, we can take it into the income statement, right? Because it's an income, we are generating an income, we are getting an income because our asset is being has a higher value in the market, right? So we say that if the asset is gaining, we should debit asset with 20,000, and then we should credit what? Our income or statement of comprehensive income? When we talk about statement of comprehensive income, then there comes the standard which says, okay, what items do you record in income statement? IAS 1, the presentation of financial statements, the conceptual framework, the regulatory framework. Okay, the conceptual framework and the regulatory framework. We will have a separate class for those frameworks and we will be discussing them in very much detail so as to cover the section A of our exam paper. But for now, I'm only taking a chunk from the conceptual framework and the regulatory framework to explain this point to you. And that is, if we are thinking about crediting the statement of comprehensive income with the revaluation gain, or to credit the income statement with the revaluation gain, if we talk about this, then the regulatory framework asks a simple question: what do you record in income statement? What are the things which can be recorded in income statement? When the regulatory framework asks this question, in the very next line it answers that you record income and expenses from the normal trading of the business, from the course of the action or the course of activities which a business follows. Those activities incomes or the expenses of those activities is basically recorded in the income statement. That is the trading which you do, the business which you do, expenses and income of that business are being recorded into the income statement. This revaluation gain is not from your normal course of activities. This is from the gain. This is from basically the gain of the non-current asset that you have. This is not a normal gain. This is not a normal income. This is not a normal profit which you earned from the normal course of activities. Then if we can't credit it over here in statement of comprehensive income, then what should we credit? Again, the framework says revaluation gain or revaluation surplus will be recorded as equity. That is, will be recorded as equity means you will be recording it in the statement of changes in equity. It will be the part of the statement of changes in equity. You will be reporting it into the statement of changes in equity portion of the financial statements of a business. You won't be reporting it into the normal income statement. Rather, you will be making a statement of changes in equity where we record the share capital, share premium, retained earnings, then the revaluation surplus, revaluation gain, or revaluation reserve will appear, and this gain will be recorded into the revaluation gain or into the revaluation surplus. This is how it records basically, that you increase the value of the asset or you increase the asset with the revalued amount, and same corresponding entry, same credit entry is then recorded into your revaluation gain or into your revaluation surplus. This is how what we do, or this is how we actually record our revaluation gain or surplus. Now, if we talk about how the actual the accounting works or how the books work, what we actually do is asset minus accumulated depreciation is equal to carrying value, right? This is something we just learned. And then here. Now I'm saying 100,000 minus accumulated depreciation is basically of 30,000. This says the carrying value is at 70,000, right? This is what we are doing. Now, when we debit asset over here, there are two ways to solve again. If the company is having a separate accumulated depreciation account, then the entry will be different. If the company is only maintaining a carrying value account, then the entry will be different. Now, let's see both of the situations. The first one is categorically the easiest one, and that is we reverse the depreciation over here. For example, let me show you. The actual entry which we pass over here is accumulated depreciation debit with 20,000, and we credit revaluation gain with 20,000. We reverse, first of all, we reverse the depreciation. And we will reverse the depreciation of 20,000 because the 20,000 is gain over here. Reversing the depreciation means we will deduct the 20,000 from here, and obviously we will have 100,000 minus 10,000, that is equal to 90,000 carrying value, which is now same like our fair value. This 90,000 is fair, is same, carrying value is same now as of our fair value. Now the rule of thumb again, why are we reversing the accumulated depreciation? Why this 10,000 is not been added into the asset? When we ask the why, then the question, then the answer of the question is simple. What is the depreciation, by the way? It is the estimation. We thought about that the asset is about losing 10,000 a year of its value after giving us the benefit, right? What's the depreciation is? Basically, it's the decrease in the value of an asset due to its use, right? We estimated that the asset is losing 10,000 as 10,000 per year as in its value because of its use, it's losing. So we thought at the end of year 3, 10,000 each year, it would have lost 30,000 of its value, and the remaining carrying value of the asset is 70,000. But in actual, the market says that the asset is still worth 90,000. It means we overestimated, we over-exaggerated, we over-calculated the value by which the asset lost its value. So what we are going to do is, this is again an estimate, we are going to change it, we are going to reverse it, and what we are going to do, we are simply in this year, in the current year, what we will do is, we will reverse the accumulated depreciation by the revalued amount, and that is 20,000. So we just reverse the excess depreciation which we had charged in the previous years, and this will be reversed, and the carrying value of the asset will be at 90,000, which is now equal to your fair value. I'm repeating my point again. Whenever we revalue an asset, to record a revaluation, we have to pass a double entry, after which we have to amend our accounts, or we have to record the revaluation into the accounts as well. So now for recording into the accounts, what we have to do is we have to go through a proper process. And the proper process is we have to see and check if the separate accumulated depreciation accounts are maintained by the entity or not. If the separate accounts are not maintained for the accumulated depreciation, so it means only the carrying value of the asset is given, right? What we are going to do is we are simply going to record asset 20,000 as a debit, and the credit will go to the revaluation surplus or gain with the 20,000. That is obviously if the asset is sitting over here at its carrying value. So technically what you only have to do is 70,000 is the value. You just have to add 20,000 with the revaluation, and it will be onto the 90,000, and it is straight away your revaluation gain. It will be recorded at 90. So now this 90,000 is going to be the fair value of the asset. On the other hand, where accumulated depreciation accounts are maintained, where you keep the accumulated depreciation accounts, what you have to do is you have to reverse the depreciation first. You have to reverse the depreciation first. What's the depreciation? That you estimated the asset will lose its value over the years. You estimated the asset, you estimated that the asset should have lost 30,000, 10,000 per year, its value in the name of depreciation. But according to the market, we can now see that that asset is appraised, or asset is like, having a fair value of 90,000, which means that instead of losing 30,000, the asset only lost 10,000 of its value because it's supported at 90,000. Huh? So what we are going to do is we are going to deduct the 20,000, the revaluation gain from the accumulated depreciation to restate our asset at 90,000. This is how the asset is going to be reported. This is how the debit half of the entry will work. This is how the debit half of the entry is working. Because in the credit half, the revaluation gain is already recorded at 20,000 into the statement of changes in equity. There is no issue with the statement of changes in equity. The asset is still recorded at 20,000 over there, right? The asset is still recorded at 20,000 over there. That there is no issue for the credit half. We are discussing the debit half where we are recording our non-current asset. And now at this point, we are recording it at 20,000. I mean, we have to record the accumulated depreciation. We have to reverse it by 20,000. Obviously, we will be reporting the asset at 90,000, which is the fair value. Now in situation 2, where the fair value of the asset is 110,000. Now let's take a look at this example, where the asset's value is 110,000. Now what we are going to do? First, we are going to reverse this 30,000 as a whole from the accumulated depreciation, and then we will add 10,000 in the asset, and now the totals are 110,000 minus 0. This is going to be 0, right? Because 30,000 minus 30 is 0, and the carrying value is now 110,000. See, this is the 110,000, which is the fair value of the asset now. Again, the rule. To record the revaluation gain, first, reverse all of the depreciation that is being given in the accounts. First, reverse all of the depreciation that has been given in the accounts, or that has been available in the accounts, right? Like we did over here, we had a revaluation gain of 20,000. We reversed our accumulated depreciation, right? First, what you have to do is reverse all of your accumulated depreciation. Over here, the fair value is 110,000. Fair value compared to carrying value. Fair value 110,000. This is the comparison. We have the carrying value at 70,000. There is a gain of 40,000. So now we have to record the gain of 40,000. So now for recording the gain of 40,000, what we are going to do is first we are going to adjust this gain, all of this gain against all of the accumulated depreciation. We saw that the gain was 40,000. The total of the accumulated depreciation was 30,000. What we're going to do is we are going to reverse all of the accumulated depreciation. We have reversed all of the accumulated depreciation over here, and this is the 30,000. We reversed all of this depreciation, right? And now if the balance remains on the revaluation gain, what we are going to do is now we are going to add up that balance into the assets cost account. Now we are going to add up the balance of the asset in the cost account. Now, as far as these workings are concerned, we are like, reversing the cumulative depreciation. We are adding the value of the, like, non-current asset or the assets account. Let me show you with the T accounts. We prepared these T accounts, right? Remember, we did like, these T accounts a while ago into the cost model. Now the effect of revaluation. Check the effect of revaluation. If there is any revaluation, it is going to be recorded over here. Revaluation gain. See, this is recorded here. This is the revaluation gain. This is the point. Let me share the screen with you again. This accumulated depreciation, this reversal which we did, we are deducting the accumulated depreciation, right? We are like, deducting the revaluation gain from the accumulated depreciation, right? So this gain is being deducted over here in the T account, because this is the depreciation charge for the year, right? We have increased the depreciation now, and now we are deducting the revaluation gain. And similarly, this revaluation gain will be recorded over here as well. When we have to increase the value of the asset, when we have to increase the value of the asset, this revaluation gain will be recorded over here as well. This is how the stuff works, or this is how this, like, entries are going to work over here. This is how we talk about the effect of the revaluation. Now, moving ahead, let's see another example. Let's check another example and see how it works. Suppose an entity buys a non-current asset for 500,000. The useful life of the asset is 20 years. After 7 years, the asset is appraised as having a fair value of 480,000. The directors want to reflect this value in the accounts. Show how the revaluation be recorded in the accounts. So this is the question. Suppose an entity buys a non-current asset for 500,000. The useful life of the asset is 20 years. After 7 years, the asset is appraised as having a fair value of 480,000. The directors want to reflect this value in the accounts. Show how the revaluation be recorded in the accounts. So now again, this is a 3-step approach. Step 1, we have to calculate the carrying value of the asset at the same date of the fair value. That is, we have to calculate the carrying value of the asset on the date at which the fair value is given. So let's start with that. 500,000 being the cost divided by 20. We have 25,000 depreciation charge per year. As 7 years have passed, we will multiply it with 7 and we will have 175,000 accumulated depreciation, right? So the carrying value of the asset at the end of year 7 will be 500,000 minus 175,000 is equal to $325,000. Done. This is what the carrying value of the asset is. Now in step 2, we have to compare the fair value with the carrying value. The fair value is now 480,000. Carrying value is 325,000. So it means there is a gain of 155,000. There is a gain of 155,000. Now, how are we going to record the gain? How are we supposed to record the gain? To record the gain, what we will do is this is the cost minus accumulated depreciation, carrying value, okay. To record the gain, what we will do is we have, as we have already discussed, we are going, step 1, we are going to reverse the whole of the accumulated depreciation being charged, right? First, what we do is we reverse all of the accumulated depreciation being charged. So what we are going to do is we are going to reverse 155,000 from the accumulated depreciation. We are going to have 500,000 minus, when we reverse 175 with 25, we get remaining balance of what? 20,000 is equal to 480,000, and this 480,000 is basically your revalued amount. And on the back end, the double entry which we will be doing is accumulated depreciation debit with 155,000 and revaluation gain or revaluation surplus credited with 155,000. Done. This is how the revaluation gain is being recorded. Another point in revaluation gain which we have to discuss today is at times directors want to realize this revaluation gain. At times directors want this revaluation gain to be reflected into the accounts. Now, why do the directors emphasize on realizing this gain at the very first place? This is a big question. I mean, why do directors wish this gain to be reflected in the accounts? I mean, obviously, when we have recorded this revaluation gain, this gain is now reported into the accounts. They can see it into the statement of changes in equity. What is basically the meaning that the directors want to reflect this gain into the accounts? This means that apart from this gain, apart from this everything, if we look at this example, we now see that the carrying value of the asset is 480,000, right? Now, depreciation for next year, 480,000, remaining life. 7 years have passed. Total life is 20 years. It means remaining life is 13 years. It means if we divide 480,000 by 13 years, we get 36,923 as a depreciation charge, which depreciation before revaluation, which was at 25,000 per year. See, 500,000 by 20 years is 25,000 depreciation charge. We had this depreciation charge of 25,000, before revaluation. This is the revaluation, this is the depreciation charge which we had. Please don't mind, you guys have to wait for a second. I just have to grab the charger from my laptop. Its battery is getting low. Just wait for a sec. Okay, so we were discussing that the depreciation charge before the revaluation was just $25,000 per year, right? But now, as the assets amount has been revalued to its fair value of 480,000, now the depreciation charge is 36,923. 36,923. It means excess depreciation charge per year is 36,923 minus 25,000. We get around 11,923. This 11,923 is charged now. This 11,923 is charged excess than it was being charged a year before. Obviously, last year we were charging 25,000 as a depreciation, but now this year we are charging, or we are going to charge 36,000. Means the depreciation charge has increased by 11,923. It means our profit is now going to be understated by 11,923 because of the excess depreciation. All else equal, everything remains the same. Assumingly, our sales remain the same, our costs remain the same, our profit remains the same, excluding the depreciation thingy, our profit remains the same. Now, last year when we charged depreciation of 25,000, we had a certain profit. Now, when we charge 36,923, the revised depreciation charge from the revalued amount this year, our profit will drop by straight away 11,923 without doing anything. It means if we incorporate the fair value model, our profit is kind of decreased. This is something not welcoming for the businesses or for the directors or the owners of the businesses. That means if you revalue your asset, you reflect the market value of the asset, the excess value at which the asset is being reported into the market, or the asset is worth in the market. But at the cost, what's the cost that we have to bear in order to reflect the asset at its market value? That is the decrease in the profit just because of the excess depreciation. Now, this is something we can say this is an unfair treatment. Just because you want to show your asset on the market value, you have to sacrifice your profit. You have to sacrifice your profit just because of the excess depreciation. Now, in order to nullify this effect, what the directors do is they start making the realization of the revaluation gain. They start realizing the revaluation gain into the statement of comprehensive income. And how do they realize this gain is how the revaluation gain is realized. That is how to realize a gain, that is total revaluation gain from a particular asset divided by remaining useful life of that asset. That is, what's the total revaluation gain? 155,000 is the revaluation gain, right? Divided by remaining useful life. What's the remaining useful life? That is 13 years. Now let's solve 155,000 by 13. 11,923. Now this 11,923, does it sound familiar to you in any context? This 11,923, does it sound any familiar to you? This is the same 11,923 which we were discussing over here. See, excess depreciation was being charged by 11,923. We calculated just moments ago to check what will be the change or what will be the excess depreciation that we will have to be we will have to face or we will have to charge in accounts in order to reflect the revaluation gain into the accounts. And the result was we had to charge 11,923 as an excess depreciation. Now, when we look at their realization of the gain, that is, we are going to realize the gain from the revalued amount or the revaluation gain. So the rule to realize the gain is to divide the revaluation gain with the remaining total useful life, remaining life of the asset rather. And that was the 13 years. What we get? 11,923. This is the amount which is going to be realized. And for realizing, the double entry is going to be debit revaluation gain and revaluation gain with 11,923, and the credit entry is going to be statement of comprehensive income. We can record this into the statement of comprehensive income. We can go for the retained earnings as well. We can transfer this to the retained earnings as well. Basically, the concept is to nullify the effect of the excess depreciation. By this, you report your asset at the fair value, and the effect of excess depreciation is technically nullified by this way or by this adjustment. Now, if you have any question, any query related to the revaluation reserve or related to the example which we did, if you have any question, please feel free to ask. Because we are going to wind up our today's session up till this revaluation, because obviously because I don't want to give pressure onto you guys on the very first day, and secondly I don't want to speed other things so fast so that it gets difficult for you. So that's why I've decided to keep ourselves up till here to this revaluation gain and surplus and the adjustment of the surplus thingy over here. Obviously in the next class when we will meet up, we will revise a bit our whole of the topic in the first 5-10 minutes. Then we will start practicing some of the questions from the exam kit. Then obviously we have to move forward into the IAS 16 as well. And in the next session, obviously we will be like, indulging the IAS 20 government grants and the IAS 23 borrowing costs with this IAS 16 as well. So if you have guys have any question to ask, please ask now. I hope you guys are not sleeping.
It's okay for now. It's clear.
Okay. If you have any question, you can ask. Yes, the other ma'am.
No, it's okay, sir. It's very clear. Your explanations are very clear.
Okay, okay. What about the other two students? I only got like, response from the two students. What about the other two?
It's okay for me too.
Okay, for you too. And the last one? Okay, one thing I want to ask from you guys, are you guys satisfied with like, the way I'm interacting and like, discussing on the word? Or if you want to change, or you want like, the lecture to be delivered in some other way, you can like, discuss that as well with me. I mean, if you want, like, I to add up some PowerPoint slides, or like, to add up, have a feature of the whiteboard as well. I have the whiteboard over here in the class as well. If you want that feature or something else, you can ask for that as well. I mean, you guys are open for suggestion. I'm open for suggestions, because again, I told you earlier, this is a like, two-way communication thing, right? Because if I keep on trying from my side, and if my efforts are not in such a way that can like, you can ease up with them, then I guess there's no point of like, me putting in like, all the efforts. If you guys think this is okay, then I'm fine. And if you guys think that the things should be changed a bit, or we should change some way, like, or you guys can add up anything you guys want to.
For me, it's okay the way you're delivering the clause.
Okay.
Yeah, it's okay. But I just want to know, can we even chat, because I wanted to send some queries, but I'm unable to send my responses on the chat box. Then I had to stop you to explain. If we
But I
can
guess the
use
chat is open, I guess. You can't chat?
no
No,
no
it's disabled.
disable.
Okay, let me check. Let me check. Okay, let me check with the settings. Obviously, if it's disabled, I'll ask like, the guy from the IT department to get it fixed, because I'm not very good with the Zoom and all. But if you wanted to ask anything, you could have unmuted yourself.
Yeah, that's why I've done.
Yeah,
I
because
have done. Yeah.
yeah, I got your point. I got your point. From the next class, the chat option will be enabled. I'll get it. I'll get the IT guy to get it fixed. And like, again, it's a good thing. If you want to type into the chat to ask anything, you can. But you are more than welcome as well. Like, to raise your hand, or like, to unmute yourself and ask anything you want. Because at times when we are typing into the chat, if I am like, delivering the concept on the other hand, maybe while typing, you get like, you get you grip loose on that particular concept as well. So fine, the chat option will be enabled. I don't mind, and I'll get it. I'll make sure that it's like, get fixed like, in a while or so. And but like, apart from that, even if you unmute yourself and ask the question, no problems for me. I don't mind. But the chat point, it's very valid. I'll get it fixed. No problems. Anything else?
So it's okay for me up to now. Yeah. We can understand. It's clear the examples which you are giving. So it's good. It's a good start.
Okay, thank you. Thank you. Thank you so much for that. And I'm just making sure, you know what? I just don't want to jump onto the like, the hardcore, like, F7 concepts, and like, because technically, F7 is a bit of a difficult paper, because it requires computation, it requires a vast knowledge and the application as well. I'm kind of assuming that you guys are weak in F3, or you guys were weak in financial accounting as well. So what I'm trying to do is I'm trying to build a base, and at the same time I'm giving you the upper level examples which are required in F7 as well. So, firstly, what I did in today's lecture was I wanted to have a more interaction with you, but maybe you guys are like, because I was being told that you guys will be kind of like, onto the less side of communicating and all, but your communication was fine, all four of you. Matlab, somehow, some way you did, but you guys did. You did communicate. This is a good sign. We can like increase our communication gap, and we can reduce our communication gap, and we can increase our communication, so that like the concepts are delivered in such a way that they are easy to understand, because you can read from the book. You can read from the book as long and for as much as you want, but the book will only explain up to the lines which are written in it. It cannot explain you from out of the way. For that, obviously, you need my help. So I'm available over here. I'm kind of like, I will work on like, further as well. So as to like, this, to make this class or this session into more comprehensive and into more like, interactive one as well. So this was a start. I wanted to have an idea. I got the idea. And as I've told you that like, in the next class, we will be doing the exam kit. We will be like, following some of the examiner's point, because what the examiner says in the paper, if you like, look into the examiner's report and all, I only found one thing in common in all of the past 5 years or so. Since the format has changed to the CBE and all, examiner always emphasize on one thing in particular, and that is that the students don't read the question carefully. They hurriedly read the question and they start attempting or they solve the question, but obviously when they solve the MCQ or they solve the question, they tend to skip what was being asked in the question, or they tend to skip from the crucial requirements of the question. So this is something during the course we all have to work together. This is something we all have to focus together on, because we have to decide about, or we have to practice on our exam approach, or on on solving the questions are concerned. We have to work on that approach as well. So hopefully from next time we will be focusing on to that as well, and I will make sure that next time when I come, I have the questions are ready right now as well. What I want to say is I want to make sure that next time our interaction is way better than it was today as well. So I hope, I guess it's all for today. If you have again any feedback or any question or any suggestion you guys want to give, you guys can give. All okay?
Yeah, all
Yes,
Okay, it's
all
done
okay.
now. Okay. Okay, then take cares. Take care of yourself, and we will meet next week. Till then, bye bye.
Thank you, sir.
Bye.
Thank
Thank
you.
you, sir.
Thank you.
Bye.